Here to dive into industry trends with leading ETF experts, this is ETF Spotlight with Neena Mishra.
Hello and welcome to ETF Spotlight. I'm your host, Neena Mishra. My guest today is Matt Bartolini, head of Spyder America's research at State Street Global Advisors. We're talking about the market outlook and some investing strategies for the new year 2022. Matt, welcome back. Great to have you on the show.
Yeah, great to be here too.
So we know that stocks have staged this impressive rally this week because investors are now less worried about the Omicron variant. It seems it will be less harmful than earlier feared, and the existing vaccines plus the booster may be effective against this variant too. And this came after last week's sell-off because investors were worried about this variant and also about Fed's hawkish pivot. And the jobs report for the month of November, which was released on Friday, that raised more questions than it answered. So talk to us about your thoughts on the recent market action.
Yeah, I mean, the markets were very jittered from the news of Omicron as a result of just another macro risk that they had to deal with. It also happened over sort of a shortened holiday week where liquidity wasn't as strong. But it just sort of, harkened back to this notion of still ongoing uncertainty with respect to the pandemic, even though we've made great progress. And we are further down the Greek alphabet. Omicron is not the first variant. It's not the first variant that spreads very rapidly either. You had Lambda and Mu as well. Those are largely confined to, Latin American nations and did not spread past those borders. In South Africa, it has. I think, the market was responding quite correctly to be nervous about a fast spreading variant where there's this information vacuum of what does that actually mean? Because both Lambda and Mu, and I'm no epidemiologist by any stretch of the imagination, were fast spreading but not severe. And it looks like Omicron can be that. And there has been some more positive news as of late, and this has sort of sent the market higher around the efficacy of some of the vaccine treatments to Omicron and what that could mean in terms of from a health perspective, and the market responded favorably. I think what happened though around Omicron, it sort of dovetailed into some hawkish language from the Federal Reserve, speaking about their policy decisions that could be coming down the road about quickening the tapering of asset purchases. The market so far is now sort of taking that a bit in stride. I think what you originally saw with the spike in volatility and immediate de-risking from some of the more high-frequency algorithmic quantitative trading models. And then now we're starting to get more back into a fundamentally driven marketplace. You're seeing from a performance perspective, you're seeing profitable stocks or profitability, quality starting to do well. You're also seeing value stocks do well as well. So after initial knee-jerk reaction, there's a little bit of a calming of tensions, but I wouldn't say that this will be the last sort of variant-induced volatility episode because we're likely to have more until we get a higher vaccination rate.
So yes, as you mentioned, the markets have been quite volatile lately, and we could see more episodes of this volatility. But we have seen a pattern of buying the dips by investors, and particularly dips in technology stocks. And it seems that strategy has worked throughout this year. Do you think we will continue to see these buy on dips, and will that work?
Yeah, I mean, I think what we've really sort of witnessed, I would say really in the last 7 years, has been this idea of more episodic volatility, not so much auto-correlated volatility that is trending. Even within the onset of the pandemic, that was, very episodic, sharp drawdowns followed by a significantly sharp rally. And I think we're going to continue to see that because of a couple things in our current environment. Monetary policy is accommodative. So I think there's a backstop in terms of the overall risk that the market is willing to see spike. You also have accommodative fiscal policies. Again, those are going to add liquidity supports to the marketplace. And also, even though earnings growth and overall economic growth are set to decline from the peaks that we have now, it's still constructive for risk assets, can be beneficial. So there's a stronger backstop that allows people to, buy the dips, so to speak, after this periods of episodic volatility that create a shock to the system. And I think that is going to continue to happen. That should continue to happen because variant-led volatility is not so much about the variant itself, but the uncertainty that it creates, because we still don't have all the information at the time a first variant is reported. It takes some time to figure it out.
Right. So let's talk about your 2022 ETF Market Outlook. And State Street released their market outlook yesterday, I believe. And you believe that the bull market's foundation remains very strong heading into 2022. And you mentioned some of the factors like monetary policy will remain accommodative because even though the Fed has started tapering, they are not going to raise rates anytime soon. And fiscal policy is very, very accommodative with the new massive infrastructure bill. And if the Build Back Better framework, if that turns into law that passes, then we will see even more fiscal stimulus. So tell us what investors can expect from 2022.
So I think you can expect a few different things. It really just sort of speaks to the environment we're in right now. So we have had peak growth. We've also, I think, in my view, had peak inflation. Doesn't mean we're not going to have low inflation going forward. It's still likely forecasted to be above, 3%, but we're not likely to see the 6%. Part of that's from a mathematical standpoint of the low base effects being removed as we go into 2020. The comparables are different. So you have peak growth, peak inflation. We also are in an environment of really peak political coordination. You do see both sides of the aisle coming together and getting deals done. I think as we head into the midterm elections, that's unlikely to happen. I think you'll see more rhetoric and more sort of political infighting, and that can create some instability in the marketplace as well. I also think you're seeing a peak of policy coordination across global central banks. You are seeing, obviously, the Federal Reserve is expected to tighten through interest rate increases, but a quickening of their tapering, which still, even if it's quickening, it's still accommodative. They're still buying, just buying less. But other central banks outside the U.S. are not. They're remaining steadfastly accommodative. We see the divergence in the U.S. in sort of the 2-year yields of certain nations, and those yields are the more susceptible to central bank policy. So in this type of environment, what we should expect is we're moving from this notion of a boil to a simmer in terms of growth, and that there should be a higher preference paid for the sustainability of earnings growth, the quality nature of balance sheets, and the ability to withstand any margin compression. So that's why I think, in my view, we have seen a gravitational pull more recently towards firms that are viewed as highly profitable and are more quality in nature. And I think that's what you should expect in 2022. And lastly, in terms of expectations, the U.S. is likely to lead again. The U.S. from an earnings sentiment is higher than the rest of the world, particularly EFA and EM. EM is likely to lag. They, whether it's through uneven COVID responses, and as well as certain nations not able to withstand the inflationary shocks and having to raise rates, but also earnings sentiment is quite poor from that perspective. There's basically the equal amount of upgrades to downgrades right now from a 2022 earnings growth perspective.
So you mentioned some interesting points. You mentioned inflation, which remains a concern because we could see faster tapering and we still have so many disruptions in the global supply chain. Then you also mentioned that we might have seen the peak in earnings and economic growth, even though growth should stay above trend. You talked about peak in political coordination, and there's another risk of maybe higher taxes and higher regulatory oversight on tech giants. So in your view, what is the biggest risk, or what are the biggest risks for investors as we head into 2022?
Well, I think the biggest risk is that what propelled performance in 2021, it was earnings growth. and earnings growth is likely to subside into 2022. It's likely to only be in the single digits. So 100% of the returns can be attributed this year to earnings. Next year, if that was to take place, that would be around a 9% return. And those are, okay returns, but they're not the double digits we've witnessed over the last 3 years, each calendar year. So I think some of the biggest risk is, what is going to be the driver of returns in 2022? And if it's going to be multiple expansion, that's only going to increase the elevated valuations that we see right now, particularly within some of the growth stocks. So I think that's some of the biggest concern is that at what point do these valuations that the broader market is trading at become too high relative to the growth that you're purchasing? And I think then, as we mentioned earlier, even though there's a stronger backstop for risk, valuations is one area where that backstop is a little bit weak. And if multiple expansion really drives this market rally, that could actually lead to one of the weak sort of chains in the backstop to start to wilt a bit more.
So in view of the outlook that we discuss, how should investors position their portfolios for 2022?
Yeah, so in our view, knowing that in the road ahead, that sustainability of profits are likely to be of a greater concern or of a greater emphasis. Having a bit of a quality overlay to a portfolio should be helpful. However, quality stocks, much like the broader market, are trading at elevated valuations. They're in the 90th percentile relative to their own respective history. They're not as stretched as, say, pure growth stocks, but they are stretched. Now, to sort of dampen some of those valuation concerns, you can include value stocks. Value stocks are trading cheap relative to the market, cheap relative to growth, basically 2 standard deviation cheap at this point, which is nearing .com levels to growth stocks. You also have an added benefit from a macro perspective. In our view, you are likely to see higher rates as the Fed starts to tighten and taper, and value has a higher correlation to movements in interest rates than does growth stocks. So I think blending value and quality in the core could be helpful to navigate an environment that is likely to witness elevated valuations, but also a little bit of a more rocky path in terms of growth projections.
So could you talk about some of the ETFs that investors could use to blend these two elements of quality and value in their core portfolios?
Yeah, so within ETFs, there's a lot of different strategies out there in the marketplace. And I think in our view, within our lineup, there are 2 that can uniquely fit this. One is a multi-factor combination of quality and value, as well as minimum volatility, which could be helpful in terms of still a highly volatile market environment. The VIX is over 20. We saw it get up to over 30 as a result of Omicron concerns. But a multi-factor combination, so the ticker for our fund is QUS. So it's the Spyder MSCI Strategic Factors ETF. That blends, quality and value together and is a core holding because it owns, over 500 or so stocks. But there's also a different route you could take with, focusing in on high quality dividend paying equities. Dividend stocks, dividend yielding strategies, they are value oriented. If you look at the selection criteria, it's a value screen of, dividend divided by price. But if you look at companies that have increased their dividend for over 20 consecutive years, that gives a decent amount of rigorous approach in terms of balance sheet, right? They've been able to withstand different economic cycles. So in our view, you can use a high quality dividend strategy like an SDY, the Spyder Sp Dividend Etf. I think those 2 come right to mind in terms of implementation of a quality / value exposure that is also core oriented.
So I'm looking at these 2 ETFs. The first one, QUS, that has Apple, Microsoft, Johnson & Johnson, and Facebook, which is now known as Meta Platforms, and United Health and NVIDIA as its top holdings. And all these companies, we know that these are profit-making machines. So exposure to them makes a lot of sense. The other ETF that you mentioned, the Spyder Sp Dividend Etf, the ticker symbol is SDY, and Its top holdings are AT&T, ExxonMobil, Chevron, AbbVie, and some other well-known names. Now, another strategy that you mentioned in that note mentions inflation beneficiaries. And inflationary concerns have been rising over the past few weeks in particular. And last week, Jay Powell, the Fed's chair, said that he's retiring the word transitory, which he had been using to describe US inflation for months. And he added that sustained inflation could ultimately force the central bank to accelerate the tapering. And we know that we could have a very large fiscal stimulus in the coming months. So yes, inflation would be a concern. Talk to us about why investors should and how they can focus on inflation beneficiaries.
Yeah, I mean, earlier I said we were at peak inflation, but that doesn't mean we're not going to have any inflation. Inflation expectations for 2022 are 3.3% and 2.8% for 2023 on a global scale, right? So there's still going to be inflationary pressures, whether it's through higher wages, increased prices. We're seeing that from some of the small businesses. According to the National Federation of Independent Business Survey, currently 53% of business owners are expected to raise prices. That's the highest percentage ever. So we're going to have higher prices, and there's still going to be some strong CPI prints out there, just not the 6% we've seen. It'll probably be in the 3 to 4%. And when we're looking at this, you want to focus on areas of the marketplace that have a strong labor intensity or less labor intensity and more capital intensity, because they may feel less margin pressure in 2022 and beyond. And as in our report, we showed that if we look at sales per employee as one metric of labor intensity, REITs have the strongest ratio, roughly like 7 to 1. And the next one is natural resource equities. So we think, combined, those two can be, areas of the market that could be inflationary beneficiaries because they are more capital intensive, not so much labor intensive. And we looked at this over time too. We broke out CPI periods by quintiles. So quintile 1 being the highest inflationary market environment with a 3 to 4.5% rate on average. And in quintile 1, on the average 12-month return, the average 12-month return of natural resource equities since 2002, in a quintile 1 inflationary period was around 15.5%. REITs was around 8%. The broader S&P 500 was only around 1.5%. And this is the same trend if you go to quintile 2, which is a 2.3 to 3% on average inflation. So we think in this type of market environment, we're likely to see inflation with a CPI print around 3%, focusing on more capital intensive and less labor intensive markets like REITs and global natural resources could be helpful. Also, directionally speaking, if we're looking at small caps versus large caps, we like small caps too from an inflationary perspective. They have a higher beta to the overall movements in 10-year break-evens. They also have a higher beta to the U.S. 10-year yields. And we think that, owning small caps relative to large caps and sort of changing some of the dynamics there from a market cap weighted paradigm perspective could be helpful in sort of positioning for a higher inflationary regime. Also, banks could be another option for investors in this marketplace. They also have a high relationship from a beta perspective to break-evens and yields. And in our view, we are likely to see higher rates. So I think banks could be added into a portfolio as well, seeking to mitigate some of the impacts of inflation.
Excellent stuff. Now, switching gears a little bit, I wanted to briefly discuss ETF Flows, which I know you track very well. So we have already seen more than $800 billion in flows into US-listed ETFs year to date, and that compares with about $507 billion in 2020. So what are your key takeaways from these massive ETF inflows?
Yeah, so one of the things that I've done here, we built out a 5-factor model to try to model out flows. And based on that model, I'm sort of calling my shot here. We project $847 billion for the industry. So that's the number that I'm keeping an eye on to see if the model has been trained correctly. But then also, what it says about the buying behavior, it's really been led by equities. Equities have taken in the lion's share of all the flows. Their records, fixed income ETFs are unlikely to break their record from last year. But that doesn't mean they're not seeing strong flows. It'll still be over 200 billion likely, which is the second year in a row that's ever happened. But the buying behavior continues to indicate a risk-on type of of mentality by investors. So, buying dips, continuing to position for a constructive backdrop for risk assets. And it also speaks on a more macro level, the ongoing secular use case of ETFs in a portfolio, whether it's their transparency, the multitude of exposures that are provided, the flexibility to go long, short, have derivatives off of them, the tax efficiency. We're seeing a really low number of ETFs pay capital gains this year. Conversely, a lot of mutual funds are. And then also the use cases continue to expand. I mean, sector flows are at records too. They're $80 billion. So you're seeing more users come into the ETF marketplace, find the right exposure for them in a given market, and position portfolios accordingly. And in some cases, just by broad beta, but then also in other cases, really make discrete active bets using some of these macro, quote unquote, exposures like financials or quality or banks and healthcare and technology firms.
Very interesting and very exciting for the ETF industry. That's all we have time for today. Matt, thanks again for joining us.
Thank you.
Thanks for listening. If you like our show, please leave us a rating on iTunes or wherever you get your podcast. And also make sure to subscribe so that you do not miss any episode. If you have any comments, questions, or suggestions, please email podcast@sachs.com.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.